Picture Earth at night. North America, Europe, East Asia, lit up like microchips on a circuit board. Now zoom in. New York. A trader on a bond desk scans yields, credit spreads, and Fed headlines. Beijing. A policy aide leans over a chart of foreign reserves and debt to GDP ratios. Basel. Central bankers in dark suits trade careful phrases about financial stability. Different flags, different systems. But every screen in every room is haunted by the same number. $300 trillion. That's the rough size of global debt. Governments, corporations, households, all layered on top of each other like unstable floors in a high-rise. We didn't get here by accident. We built this bomb. Step back to 1944, Bretton Woods, New Hampshire. Outside the Mount Washington Hotel, World War II still rages. Inside, under chandeliers, delegates from 44 nations are redesigning money. The deal is elegant. The US dollar is pegged to gold at $35 Oz. Other currencies pegged to the dollar. Central banks, not you, not me, can swap dollars for gold at that rate. The dollar becomes as good as gold, and America, holding 2/3 of the world's bullion and a roaring industrial base, becomes the financial anchor of the post-war order. In the 1950s and early 1960s, it looks like genius. Marshall Plan money rebuilds Europe and Japan. U.S. suburbs, highways, and factories boom. Debt grows, but growth and demographics hide the danger. Gold serves as a psychological and legal brake, something that says, you can't just print forever. Then the Triffin dilemma shows up like a hairline crack in a dam. For the world to have enough dollars to trade and save, the U.S. must export more dollars than it receives by running deficits and lending abroad. The more it does, the more foreign holders ask, if there's this many dollars out here, how can they all be worth $35 in gold? France, under Charles de Gaulle, calls America's bluff. Visual. Ships loading pallets of dollars in New York and returning with gold bars for the Banque de France. Fort Knox's stockpile shrinks. On paper, the U.S. owes more gold than it has. The fuse is now lit. August 15th, 1971. Millions watch President Nixon on TV. In calm, lawyerly tones, he announces the U.S. will temporarily suspend gold convertibility. The window never reopens. Overnight, the dollar shifts from a gold-anchored promise to a pure fiat token, backed not by ounces in a vault, but by confidence in Washington. The 1970s answer with inflation, oil embargoes, gas lines, wage price spirals. Gold and silver behave the way they often do when trust in paper cracks. Gold, locked at $35 for decades, is set free, racing above $100, then $500, peaking around $800 Oz by 1980. Silver, turbocharged by the Hunt brothers' ill-fated attempt to corner the market, shoots toward $50. It's not just greed, it's a vote. A vote that says, I don't fully trust your new paper game. Economists call gold and silver inflation hedges. In human terms, they are no confidence motions in the current money managers. By 1980, it's clear. The Bretton Woods illusion, that the dollar will behave like gold forever, is dead. We've moved from a world where money is limited by what you can mine to a world where money is limited only by what people will believe. That belief becomes the new casing around the debt bomb. Once, governments couldn't easily outpromise their gold stock. Now, the only limit is how far they can stretch trust. And as we'll see next, once you remove metal and replace it with belief, the temptation to stack more and more promises on top of the system is almost impossible to resist, especially when every short-term crisis whispers, don't worry, borrow a bit more, we'll fix it later. Later is how you get to $300 trillion. But later didn't just grow the bomb, it taught finance how to engineer it, with derivatives, shadow banks, and a dollar web that wrapped the whole world. That's where we go next. The 1970s end in pain and panic. Inflation has eaten savings. Gold and silver have staged rebellions. Confidence is shaken. Somebody has to reassert control. Enter Paul Volcker, early 1980s. Tall, imposing, often photographed with a cigar, Volcker hikes interest rates into the double digits. Mortgages hit 15 to 18%. Recession rips through factories and farms. Visual, foreclosure signs, idle steel mills, angry protesters outside the Fed. But slowly, it works. The U.S. shows it's willing to accept massive short-term pain to rescue its currency. Gold and silver tumble from their peaks. Inflation expectations break. We've proven fiat can be disciplined if policymakers choose to be brutal. Yet, under the surface, the lesson many in finance take away isn't be responsible. It's, we can always smash the brakes if we overdo it. Cue the 1980s and 90s. Deregulation, globalization, and financial innovation on steroids. Reagan and Thatcher opened the taps. Interest rate caps removed, capital controls relaxed, banking rules loosened. In 1986, London's Big Bang turns the city into a fully modern electronic market. A new ecosystem flourishes. Shadow banking, money market funds, off-balance sheet vehicles, structured products, complex corporate finance, junk bonds, leveraged buyouts, ever more intricate derivatives, interest rate swaps, currency swaps, options, loans. Once simple agreements between banks and borrowers become raw material. You don't just make a mortgage anymore. You bundle thousands into securities, slice them into tranches, wrap them again into CDOs, and hedge them with credit default swaps. On paper, risk is diversified and tamed. In practice, it's multiplied and buried. Simultaneously, globalization turns the dollar into a worldwide operating system. Emerging markets are told, borrow in dollars. That's where the deepest pools of capital are. Mexico, Brazil, Thailand, Russia, South Korea, many take the deal. They borrow cheap in dollars, but when US rates rise or capital flees, their currencies dive and debts explode in local terms. The Latin American debt crisis, the Asian financial crisis in 1997, the Russian default in 1998. Behind each headline is the same pattern, a local economy tied to the dollar S terms. When those terms change, local bombs go off. Meanwhile, derivatives markets swell. By early 2000s, the notional value of derivatives clocks in at hundreds of trillions, 10 times world GDP, depending on how you count. It's important. Not all that notional equals real exposure, but it reflects one truth. We have learned to create claims on future cash flows at a speed and scale humans have never seen before. Gold and silver during this era are half asleep in Western consciousness. Central banks sell or lease gold, calling it barbarous. Silver is lumped in with copper, zinc, and other industrial metals. But their price charts tell a different story. Gold bottoms around the late 1990s and starts grinding higher. Strangely, just as the dot-com boom peaks. Silver claws up from the low single digits. To most, they're relics. To anyone watching long monetary cycles, they're early warning lights. Then housing enters the chat. 2000-2006. Low rates, lax underwriting, everyone deserves a home politics. Mortgages are originated, sold, securitized, rated away, and stuffed into every balance sheet on Earth. By 2007, the setup is precarious. Global debt has surged. The dollar dominates, but is deeply entangled in risky credit. Derivatives link institutions across continents in ways few fully understand. The system appears stable until a small weak point, subprime mortgages, begins to crack. 2008 isn't the whole bomb exploding. It's a preview. A single compartment blows out. And the way we choose to fix that compartment, by unleashing unprecedented money creation and ultra-low rates, is how we transform a big bomb into a truly existential 300T time bomb. Because after 2008, we don't choose austerity. We choose fix it with more debt. And that's where gold, silver, and the dollar quietly start to trade places. September 2008. Lehman Brothers collapses, screens flash red, credit markets freeze. The complex web of CDOs and swaps, once touted as risk dispersion, is revealed as a chain reaction machine. For a moment, the global financial system stares into the abyss. ATMs, payroll, global trade, all of it depends on those invisible credit pipes. To stop the collapse, central banks and governments go all in. The Fed slashes rates to near zero. TARP pumps capital into teetering banks. AIG, stuffed with toxic insurance contracts, is rescued because its failure would detonate everyone else. The immediate panic is arrested, but the solution is radical. Quantitative easing, QE. The Fed, ECB, BOE, BOJ, and others begin buying massive quantities of bonds with newly created reserves. Imagine their balance sheets as balloons inflating in real time, from a few hundred billion to trillions. Economic life support, yields crushed, liquidity flooded. Investors pushed out the risk curve into stocks, real estate, high-yield debt. The idea, reflate asset prices so balance sheets heal. And it works, in the short term. The S&P roars back. House prices recover. Corporate borrowing restarts, then explodes. Debt didn't go away. It was rolled and layered. The signal to markets is unmistakable. If things ever get truly bad, central banks will print and governments will borrow whatever it takes. We call this the era of the Fed put. Between 2009 and 2019, every wobble, Eurozone crisis, taper tantrum, China scares, is met with easier policies somewhere. Debt balloons. By the late 2010s, it's clear. We haven't just built a housing bubble or a tech bubble. We've built an everything bubble. Sovereign bonds at negative yields in Europe and Japan. Corporate bonds priced for perfection. Equities at lofty multiples. Real estate in major cities priced beyond local incomes. Where are gold and silver? Gold, after peaking around 2011, is written off during its correction. Silver, having nearly touched $50, is called uninvestable. Yet, central banks in emerging markets keep accumulating gold. Physical coin and bar sales spike whenever a scare hits. Silver demand slowly grows in solar and electronics, even while the price is range-bound. The old instruments are still in the orchestra pit, just waiting. Then 2220. A virus slams into a hyper-levered system. Streets go empty, planes grounded. Oil futures briefly trade negative as storage fills. In March 2020, for a terrifying week, everything sells off, even gold, as funds scramble not for safety, but for cash. If 2008 was the financial heart attack, 2020 is septic shock. The response makes 2008 look like a rehearsal. Rates cut back to zero almost everywhere. QE on steroids. Trillions created in weeks. Direct fiscal injections, stimulus checks, wage subsidies, massive deficit spending. Global debt jumps by double-digit trillions. The can is kicked again, this time so hard it's barely visible down the road. Then, as economies reopen, another ghost reappears. Inflation. At first, central banks call it transitory. Supply chains, reopening kinks, temporary. Then months go by, rents climb, food prices rise, energy spikes. It's not just transitory. For the first time since Volcker, the Fed and others are forced to do something they haven't done at this scale in decades. Hike rates fast. US rates go from near zero to levels not seen in 15 plus years, in under 2. The yield curve inverts, a classic recession omen. Bonds long considered safe get hammered as yields rise and prices fall. Banks loaded with low coupon bonds watch their balance sheets warp. And we get a taste with the 2023 US regional bank mini crisis. Visual, a bank's balance sheet with held to maturity bonds at par value and market value far below. Unrealized losses become very realized when depositors panic. This is the sound of the 300 T-bomb humming audibly. By 2024, governments owe more at higher rates. Households and corporates are strained. Asset valuations still depend on relatively low funding costs. Central banks are trapped between fighting inflation and avoiding a systemic accident. Gold is flirting with new highs, showing quiet defiance. Silver is coiling, sleepy one month, violent the next. The dollar, oddly, is both strong against other fiats and fragile against real goods and commodities. Everyone senses we can't keep doing more of the same forever, but no one agrees on or wants to admit what happens when we finally can't. Now we step into the blast zone. Slow burn repression, sudden crisis, or quiet rule rewrite, and what each path tends to do to gold, silver, and the dollar. At the core, our problem isn't just a big number, it's a simple mismatch. Too many claims on the future. Too little future income to honor them all. Every path forward boils down to who eats the loss. There are 3 broad ways this tends to play out. Scenario 1, the slow burn, financial repression. No headlines scream default. No officials say we're not paying. Instead, inflation runs hotter than interest rates. Governments and central banks talk about anchoring expectations, but real yields remain negative for years. Example, Britain and US. Nominal debt shrinks not because it's paid back in full, but because each unit of money is worth less. For you, this looks like modest pay raises that never quite catch up. Savings accounts and safe bonds that earn 2% while inflation is 4%. A sense that you're running on a treadmill set just a bit too fast. In this world, dollar, still dominant, but its internal buying power erodes. Creditor nations quietly reduce dollar holdings, pivoting toward commodities and other currencies. Gold grinds higher over years, outperforming inflation and quietly preserving wealth for those who hold it. Silver, volatile, but benefits from the dual engine of monetary fear and industrial demand. Price spikes are ugly, but trend is up. The bomb doesn't explode. It deflates into your cost of living. Scenario 2, the sharp shock, crisis, panic, and forced choices. This is the movie everyone fears, a major bank failure, a sovereign debt scare in a big economy, a cascade of margin calls and funding squeezes. First, the scramble for dollars. Institutions with dollar liabilities rush to cover. Dollar indices spike. Emerging markets suffer as their funding costs soar. But if the crisis emanates from the US or its allies, a second stage begins. Should we still keep so much of our reserves, savings, and contracts in this system? In this world, gold spikes violently as a no counterparty asset. Talk of remonetization may reappear, not a full gold standard, but gold-backed arrangements between central banks. Silver behaves like gold on caffeine. It may be dumped initially in liquidation, then rocket higher if the crisis turns inflationary or undermines trust in fiat. Dollar rallies at first, then risks a slow reputational bleed if the fix involves heavy printing, haircuts, or overt capital controls. On the street, this feels like bank lines, emergency measures. A constant question, what exactly do I actually own, and under which rules? The bomb does go off. The damage is contained through emergency politics, but scars remain for a generation. Scenario 3, the quiet reset. New money, new architecture. Here, the system's managers choose a software update instead of a hardware explosion. Think widespread rollout of CBDCs, central bank digital currencies, restructuring of legacy debts under new digital frameworks, longer maturities, lower coupons, conditional payouts, growing use of regional or commodity-linked units in trade, e.g. BRICS arrangements. Official messaging: we're modernizing money. We're increasing efficiency and inclusion. We're making debt sustainable. Under the hood, some debts are intentionally inflated away. Some are haircut via legal changes. Some are rolled into instruments ordinary people don't fully understand. In this world, dollar remains key but loses its monopoly. It shares space with other blocks and digital schemes. Gold plays a quiet but crucial role in building trust between states, often off camera. Silver may not be explicitly in the new architecture, but on the ground, in places where people distrust local regimes, it can reemerge as an informal store of value. For you, this feels more like new app for your money, subtle shifts in what your pension owns, a slow realization that your time and savings don't stretch as far as the last generation ES did. Across all scenarios, one thing is constant. Rules can change. Capital controls can be introduced. Taxes on gains can spike. Ownership definitions can be rewritten. Gold and silver have no guaranteed protection from politics, especially in jurisdictions under stress. But history shows they are less likely to go to zero. They are less likely to be erased by someone else's bankruptcy. They often act as anchors of last resort in negotiations between states. The dollar's role is more complex. It can shield you in the first wave, as others tumble, then quietly shift the burden onto you through inflation, tax, or policy. The 300T debt time bomb isn't a date to fear. It's a pattern to recognize. In every reset, three groups appear. Those who never saw it coming. Those who saw it and froze. Those who saw it, understood the history, and moved enough of their lives off the most fragile promises. The question is not whether there will be another turn of the cycle. It's whether, when it comes, you'll only see the mushroom cloud on your newsfeed, or you'll recognize the flickering lights in the system as the same warning signs people ignored in 1933, in 1971, and 2008. That recognition won't make you invincible, but it does give you something rare in a reset, a choice about where you stand when the world quietly decides which promises to honor and which to let burn.